You ever see a brand new truck that looks like it costs more than someone's house? And you instantly think, how is this person paying for that? Here's the uncomfortable answer. Most people aren't affording it. They're renting their future, one monthly payment at a time. And if you don't understand the trick, you'll be next. In this video, I'll show you the 5-step system that makes insane car payments look normal. You'll learn how dealers bend the math, how buyers get trapped, and how to escape it. And by the end, you'll have a simple rule to never get car poor again. Let's start with the most important idea. A car payment is not a price. A car payment is a story. Because if I tell you this truck costs $68,000, your brain screams, nope. But if I tell you it's only $899 a month, your brain goes, maybe. That's the trick. They don't sell cars, they sell monthly feelings. But here's the part most people miss. That monthly number hides 3 separate traps, and we're going to expose all of them. First trap, the loan term. Your grandparents had 36-month car loans. Then it became 48. Then 60, now 72, 84, even 96 months. That's 6, 7, 8 years. Some people are basically doing a car mortgage. Why does this work? Because stretching time shrinks the monthly payment. Same car, same price, different time. And your brain only sees the monthly number. Here's a simple example. $60,000 financed at 6% interest. For 48 months, your payment is roughly $1,400 a month. Most people recoil at that. So the dealer says, no worries, let's make it 84 months. Now it looks like around $875 to $900 a month. And in a moment, I'll show you why that lower payment is usually more expensive. Because the second number is the one that kills you, total paid. When you stretch the loan, you pay interest longer, and you pay more, even if the monthly payment looks manageable. But here's where everything changes. Cars don't behave like houses. They don't slowly gain value. They drop fast.
Let's talk about the silent killer, depreciation. A house is usually an asset. A car is usually a melting ice cube. The moment you drive off the lot, value drops. Not because the car is worse, because the market labels it used. Now connect that to a long loan. Long loan equals you pay slow. Depreciation equals value drops fast. That gap creates the trap, negative equity. You owe $40,000, but the car is worth $28,000. That difference is not just a number, it's a leash, because you can't sell the car without paying the gap, and you can't easily trade it in either, unless you do the most dangerous move in car buying, rolling it into the next loan. And that is the third trap. This is where dealerships print money. Let's do a clean, simple story. Meet Jake. Jake buys a $50,000 SUV. He puts little down. He takes an 84-month loan. 3 years later, he wants something new, but he still owes $38,000, and the SUV is worth $30,000, so he's underwater by $8,000. Dealer says, no problem, we'll take your trade. But that $8,000 doesn't disappear, it gets added to the next loan. So Jake buys a $55,000 vehicle, but he finances $63,000. This is the invisible backpack of debt, and it follows you. Now Jake is paying for a car he no longer owns, plus the car he just bought. This is where everything changes, because now the monthly payment isn't about transportation, it's about hiding old mistakes. That's why people look rich but feel trapped. And in a moment, I'll show you the sneakiest part of the system, the monthly payment negotiation.
When you walk into a dealership, notice what they ask first. They don't ask, what total price do you want? They ask, what monthly payment are you comfortable with? That question is a trap door, because monthly is adjustable. They can change loan length, interest rate, down payment, trade-in value, fees, warranties, add-ons, all to hit your monthly number, so you feel like you won. But the dealer just moved the cost into places you don't look. But here's the part most people miss. They can hit the monthly number even on a bad deal, because you're not negotiating a car, you're negotiating a payment illusion. And the illusion gets worse with one product people love. Only $0 down. Zero down often means you start underwater instantly. So one small accident, one repair, one job change turns the car into a financial anchor. Now let's expose the true cost, because the payment is not the cost. The payment is just the beginning. If you want the real cost of a car, you need 4 numbers: payment, insurance, fuel, maintenance plus repairs. Most people only count the first one. That's like pricing a restaurant meal by the appetizer. Let's run a clean example. $55,000 vehicle, 7-year loan, payment $800 per month, insurance $250 per month, fuel $300 per month, maintenance average $150 per month. Total monthly transportation cost equals $800 plus $250 plus $300 plus $150 equals $1,500 per month. That's not a car payment, that's a lifestyle payment. Now multiply it. $1,500 per month times 84 months equals $126,000. And at the end, your car is not worth $126,000. It might be worth $15,000 to $20,000. So you spent 6 figures to end up with a used car. But here's the part most people miss. It's not just the money you spent, it's the money you could have built. Opportunity cost. And this is where the math becomes painful. Imagine you invest the difference instead, not some fancy strategy, just a simple index fund. Let's say 8% average annual growth. If your car choice costs you an extra $600 a month and you invested that $600 instead, you're not just saving, you're building an engine. Over 7 years, that can become tens of thousands of dollars. And that's the money people never see, so they assume it doesn't matter. But it matters more than the car itself, because your car depreciates, your investments compound. One is a leak, one is a pump. Now, if this is so obvious, why do smart people still do it? Because the real product being sold isn't metal, it's identity. Car ads almost never sell math, they sell emotions, freedom, status, respect, safety. They show a truck climbing a mountain, even if your mountain is the Target parking lot. And if you're stressed, tired, overworked, a new car feels like a reward. But here's the part most people miss. A reward that chains your cash flow isn't a reward. It's a subscription to stress. Because once you lock in a huge payment, your life starts orbiting that payment. You say no to opportunities. You avoid risk. You stay at jobs you hate. Because the truck doesn't care how you feel. It wants its $900 on the first. So let's talk about the real danger. It's not having a car loan. It's becoming car poor. Here are signs your car is quietly wrecking your finances. If your payment is more than 10 to 15% of your take-home pay, that's danger. If you can't save at least a little every month because of the car, that's danger. If one repair would go on a credit card, that's danger. If you're scared to check your bank app after the payment hits, that's danger. But here's the good news. You can escape this without being cheap. You just need a simple system. And in a moment, I'll give you the exact rule I use. But first, let's talk about the dealership's favorite weapon:
Focus on what you can afford per month. Sounds responsible. It's not. The right question is not, what monthly payment can I handle? The right question is, what total transportation cost fits my life goals? Because your goal isn't a car, your goal is freedom. So here's a better way. Step 1. Decide your maximum total monthly transportation budget. That includes payment, insurance, fuel, maintenance. Step 2. Keep it boring. Boring is rich. Step 3. Buy the car that fits the budget, not the ego. But here's the part most people miss. The system is designed to make you feel embarrassed by boring, so you overspend to feel respected. Then you stress in silence. That's the trade. Now let's talk escape plan. If you're already in the trap, you still have options. If you're underwater right now, don't panic. Do not upgrade to fix it. Rolling negative equity is gasoline on a fire. Instead, do this. Option A, keep the car longer. Boring but powerful. Option B, refinance only if it lowers rate and you don't extend forever. Option C, increase principal payments to get above water faster. Option D, if the payment is crushing you, sell it and take the hit once instead of bleeding every month for years. But here's the key idea. The goal is not to have the nicest car. The goal is to have the strongest cash flow, because cash flow buys choices. A truck doesn't. Conclusion. Big insight. So how are people affording those insane vehicles? They stretch the loan. They hide the total cost. They roll old debt into new debt, and they justify it with identity. But once you see the system, you can't unsee it. Here's the simple rule that saves you. Never buy a car based on the monthly payment. Buy it based on total cost and your future freedom. Call to action. If this video saved you from a bad car deal, hit like. Subscribe for more Money Explained Simply videos like this. And comment below, what's the biggest monthly car payment you've seen in real life? I read the comments, and your answers shape the next video.